Okay, so chapter 24, standard cost systems. And so what managers try to do here is try to determine standard costs of such things as what it costs to make a unit of item of whatever they manufacture. And so what they have to do in order to figure out how much it costs on average to manufacture a particular item, they have to determine standard costs for labor, materials, and overhead. And so how does this help? Well, it helps by being able to, if you have the standard cost of a unit to manufacture a unit of product, what you can do is, as a manager, compare the standard cost to producing a unit of product to what it actually costs to produce a product, a unit of product. And by comparing the two, you'll figure out whether or not you're spending more than you should for manufacturing a product, a unit of product, or you're spending less, or you're just spot on, which doesn't happen very often. And so these standard costs are based upon carefully predetermined amounts. They're used for planning labor, material, and overhead requirements. The standard costs are measuring stick, and what management thinks is an expected level of performance, and as such is a benchmark for measuring performance. So all very good things. Remember, managing is about planning and control and adjusting. So how do we come up with these standard costs? Do we figure out based upon ideals or something that's attainable? We'll talk about that here in a minute, but just following this slide, you have your standard costs for the three components: direct labor, direct material, and manufacturing overhead. And of course, the standard cost variance is the amount by which actual costs either exceed or are below the standard costs. So it's a means for comparison. Standard cost is a means of comparison with actual costs. Now, if you have costs, actual costs that are above the standard costs, that's considered to be, by management, unfavorable. If the actual cost is less than standard cost, then you have a favorable variance. Okay, so the variance, the difference between standard cost and actual cost, whatever component you're talking about, total or direct labor, direct material, or manufacturing overhead, the difference between actual cost and standard cost is called the variance. And it can be, this variance can be either favorable or unfavorable depending on whether or not actual cost is more than standard cost. And so actual costs depend on which component you're talking about. For direct materials, actual cost is made up of the actual quantity of raw materials used to produce a product and the actual cost of producing a product. The standard cost and standard quantities is determined by whatever you've decided is a standard quantity and standard cost under the circumstances. Pretty much the same thing goes for direct labor as well. Actual quantity, actual cost is compared with standard quantity and standard cost to figure out the variance. And then for overhead, you compare the actual cost with the overhead that's applied at the standard rate and or quantity. Now, this determination of standard costs is as with so many other things, a participatory event. And so you have different parties from different areas of the company participating in determining standard costs. And so here we've got 4 people, and I'm not sure, apparently you got the engineer on the left, production manager somewhere in there, and then the managerial accountant involved as well. So the question here that the engineer is asking is, should we use normal costs or standards or ideal standards? And by far the consensus is that management, when setting up these standard costs, should use normal attainable standards, not some pie in the sky ideal, because if standard costs are unattainable, you're going to actually, well, it's going to result in dysfunction and low morale, because imagine getting beat over the head all the time with actual costs being more than standard costs. You know, after a while you just kind of give up. All right, so direct materials standards. Price standards. How do you figure out price standards? Well, the best way of doing it is using competitive bids for the quantity and quality of product desired, units desired. As far as quantity standards, you use product design specifications. That's why you've got the engineer there participating in this determination of standard costs. For direct labor standards, you're going to determine the rate standards by using wage surveys, labor contracts, and things like that. And for time standards, you're going to use things like time and motion studies for each labor operation, each component of the manufacturing of this product. As far as manufacturing overhead standards, you're going to take your rate standards The rate's based on an estimate of total overhead at the normal level of activity. And then your activity standards is going to be whatever the cost driver is that's used to calculate the overhead rate. And so here's a general model for variance analysis that you'll see a pattern. We'll take this general model and apply it to materials, labor, and overhead, but it's the same basic structure. And so to determine the price variance, you're going to multiply, and this is kind of the long way of doing it. Price variance is the difference between actual quantity times actual price versus actual quantity times standard price. And so the standard price is the amount that should have been paid for the resources acquired, and of course the actual price is actually what they paid. To figure out the quantity variance, you take that actual quantity times standard price and compare it with the standard quantity times the standard price. And so standard quantity is the quantity that should have been used for the actual output. Obviously, actual quantity is going to be what you actually used to for actual good output. Now you can take and reduce this to the following formulas for both your material price variance and material quantity variance. And so material price variance, MPV, equals actual quantity times actual price minus standard price. Material quantity variance, MQV, equals standard price times actual quantity minus standard quantity. So this is probably the best thing to use when you're figuring out these variances. And again, this is a general model, but it can be applied to both, well, to all three. Materials, determining variances for materials, direct materials, direct labor, and factory overhead. So we have an example here. Bryce Mills in Moscow, Idaho, not far from here, laminates wooden beams used in construction. I assume this is a fictitious company, but I don't know that to be a fact. The process involves two steps, cutting and gluing. And so 1.5 labor hours are allowed per 20-foot beam. So that's the standard time they've determined to make a 20-foot beam. Might it take longer? Well, yeah, it might, but that's the standard amount of time that they have determined to make such beam. The standard labor rate is $12 per hour. 264 board feet is the standard quantity for each 20-foot beam manufactured. So how did they figure that out? Well, let's go on. Standard cost of rough white pine is 25 cents per board foot. Total fixed overhead is $5,600 per month. The normal production level is 700 beams per month. So that's a lot of information. And so here, if the purchasing agent acquired the pine at 20 cents per board foot, and 180,000 feet were used to produce 600 beams, then the material price variance is $9,000 favorable. And so what you're doing here is taking the actual quantity of 180,000 feet, and you're going to multiply that times the difference between what the purchasing agent actually acquired the pine at, the 20, minus the 25 standard cost per board foot. Now, as far as the quantity variance, standard quantity of material that should have been used to produce 600 beams is 600 units times the 264 board feet per unit. So that equals 158,400. Now, to figure out material quantity variance, you simply take your standard price of 25 cents and multiply that by the difference between the 180,000 feet minus the 158,400 feet. And so the MQV here is unfavorable by $5,400. All right, so getting down to specifics as far as the labor rate and efficiency variances, you're going to have your labor rate variance and you're going to have your labor efficiency variance. And so again, this should look familiar, but we're just applying this to labor, and then you'll have a little different look to the material variance, and then another little bit different look for overhead. So labor rate variance is the difference, is actual hours times the actual rate per hour minus the standard rate per hour. I mean, we're going to be talking about dollars per hour there, right, to pay labor to produce these products. As far as the labor efficiency variance, you're going to take your standard rate and you're going to multiply that into the difference between actual hours minus standard hours. So we have our illustration here. Bryce has the following labor standard to manufacture one beam, 1.5 standard labor hours per beam at $12 per hour. Payroll records last month show 1,080 hours were worked at a total labor cost of $14,040 to make 600 beams in March. So you're going to take those numbers, and Bryce's actual rate, AR, for labor for the week was $13 per hour, simply by taking the total amount paid divided into the number of hours it took. Their labor rate variance is $1,080 unfavorable, That is determined by taking that 1,080 hours and multiplying that to the difference between the actual rate minus the standard rate. And so the difference here is $1. So 1,080 hours times $1 is $1,080 unfavorable. Some of this you can eyeball, right? Actual rate is more than standard rate, so you know you're going to have an unfavorable LRV, right? The standard hours of labor that should have been worked to produce 600 beams is 900 hours. That's determined by taking the 600 units and multiplying it by the standard 1.5 hours per unit that it should take to produce a beam or 600 beams. And so you can figure out your labor efficiency variance by taking your standard rate of $12 and multiplying it by the difference between the average or actual hours minus what they determined is the standard hours to produce these items, which is going to leave you with an LEV of $2,160 unfavorable. Again, there you can pretty much eyeball that it's going to be unfavorable because it's taking more hours actually to make these units than what management has determined it should take to produce these units. All right, as far as manufacturing overhead variances, recall that overhead costs are applied to products and services using a predetermined overhead rate, our POHR. The POHR, the predetermined overhead rate, is determined by taking the estimated total overhead costs for the period and dividing it into the estimated activity, which usually is the estimated number of units that you plan to produce in a particular period. And so after you figure that out, to figure out the overhead that you apply to each unit of product, you multiply the POHR times the standard activity. And so we have an overhead variance example here. Bryce has the following manufacturing overhead at 3 different levels of activity. And so you've got in the first 600 beams, in the middle 700 beams manufactured, and then to the right excuse me, to the right 800. You've got your variable overhead of 3,600 for the 600 beams. For 700 beams, it's 4,200, and for 800 beams, it's 4,800. So notice that for all those, the one constant is that they're applying overhead at $6 per unit. That's determined by a couple of ways. Certainly dividing 3,600 into 600 equals $6. 4,200 into 700 beams is $6, and 4,800 dollars into 800 is $6 as well. And then, of course, fixed overhead doesn't change. And so the total overhead rate for an estimated activity of 700 units is $14 per unit, which is determined by taking the 9,800 and dividing it into 700 units. And so this overhead rate contains a variable portion, and it also contains a fixed portion. And so you figure that out by taking the costs of the two. They're $4,200 for overhead, or for the variable overhead, divided into 700 units is $6 per unit, as we talked about. And then, of course, $5,600 fixed costs divided into 700 is $8 per unit, so total $1,400 per unit. And so when it comes to manufacturing overhead variances, you're going to look at two different types of variances. There's a spending variance and there's a volume variance. And in the spending variance, what you're going to do is compare actual overhead with budgeted overhead at the actual activity. And what that does is it shows how economically overhead services were purchased and how efficiently overhead services were used. It contains, like we saw, both a fixed and variable cost. This, as it points out, is a controllable variance. Now, on the other side of the equation, you're going to have applied overhead at standard hours, and you're going to compare that with budgeted overhead at actual activity, and that's going to be your volume variance. And so the volume variance is caused by producing at a level other than that used for computing the standard overhead rate. Note that it contains only fixed costs. And so back to our example, Bryce's actual production for the period was 600 beams. Actual total overhead cost for the period is 8,680, and so it asks us to compute the overhead spending and volume variances. So again, to the left you've got your actual overhead, no big deal, and so you've got in the middle, budgeted overhead at actual activity. You've got the $5,600 actual fixed costs and the $3,600 variable costs, which is the $6 per unit times 600 units. And so that equals 9,200. And so you compare actual overhead with the budgeted overhead, and you're actually $520 less in actual overhead. So that's a favorable variance. And then over to the right, what you're going to do is you're going to compare applied overhead at standard hours. That's the 600 hours times the $14 per hour, which is made up of both fixed and variable costs per unit. And so that's $6,400. And so what you're doing here is you're comparing fixed costs. If you recall in the prior slide, we talked about the fact that we're just comparing our fixed costs here. And so you take out in the middle here when you're figuring out the variance here, you take out this 3,600, you're looking at the 5,600 fixed in this instance and comparing it with this formula. Here it's 6,400. So overhead applied at standard hours is actually $800 more than the budgeted overhead at actual activity of 5,600. So you've got an $800 unfavorable variance. Not too concerned with this. If the amount of the overhead variance versus actual is immaterial, you just simply close out the difference to cost of goods sold. And if it's material, you close by apportioning the amounts to the various parts of the manufacturing process, work in process, finished goods, and cost of goods sold. But that's not a big part of this. Well, how do we evaluate these variances? It kind of depends on your perspective, who you are in this whole process. And so notice here, you've got a production manager and a purchasing agent. Production manager is responsible for taking the materials and producing the product. Purchasing agent is responsible for purchasing the materials that are used. Well, what happens if the production manager purchases inferior materials? And so the production manager has these inferior materials that they're using to make units of product. Should we blame him if he uses more material to make the same amount of product that he would make if he had up to standard or quality materials used in producing this product? And so here you get this conflict between the two. Production manager says, I'm not responsible for this unfavorable material variance. You purchased cheap material, so my people had to use more of it. And the purchasing agent points a finger back and says, you used too much material because of poorly trained workers and poorly maintained equipment. Also, your poor scheduling sometimes require me to rush order material at a higher price, causing unfavorable price variances. Sounds like it's time to get out the boxing gloves. Well, what about an unfavorable labor variance? Here, the production manager says, I'm not responsible for the unfavorable labor efficiency variance. You purchased cheap material, so it took more time to process it. And the purchasing agent says, well, you used too much time because of poorly trained workers and poor supervision. Again, this is for management to discern who's right. Looks like the purchasing agent won the arguments because the production manager is like, oh, well, maybe she's right. Anyway. You could also have a problem with labor variances by using people who are either not skilled to make the products, or maybe they're overqualified and overpaid. you're using a supervisory position at a higher paying rate to help produce this product. And so that's going to cause an unfavorable rate variance. All right, so I'll do a problem here. I'll try to do it by Wednesday and get it out there so that you have an extra day to look over that and do homework and all that stuff.